This breakdown is brought to you by Real Estate Rank IQ. We're getting straight to it, how to shrink or even completely eliminate capital gains when you sell your home.
So let's start with this number, $34.5 trillion. That's the staggering amount of home equity that U.S. homeowners are sitting on right now. It's a massive financial opportunity for sure, but it also comes with a potentially massive tax bill.
And that's the whole problem, right? As tax strategist Carla Dennis says, so many people wait until after the sale to think about taxes. But a little bit of planning beforehand can save you literally thousands of dollars. So let's get into that strategy.
Okay, first things first. We have to be really clear on what a capital gain actually is.
It's actually a pretty simple formula. You've got your amount realized. That's just what you sold the house for, minus your selling costs, like commissions. Then you subtract your adjusted basis. Think of that as your total investment, the original price you paid, plus the cost of any big improvements you made. The key thing to remember is you're only taxed on the difference, the gain, not the entire sale price. All right, now for the good part. Let's talk about the single most powerful tool you have as a homeowner, the IRS Section 121 exclusion.
Yep, you're seeing that right. The IRS literally lets you just wipe away a huge chunk of your profit from your taxes. It's up to $250,000 if you're single, and a whopping $500,000 if you're married and filing together. It's an absolutely incredible tax break. So what's the catch? Well, to qualify, you have to pass two simple tests, the ownership test and the use test. Basically, you need to have owned the home and lived in it as your main residence for at least 2 years out of the 5 years right before you sell. It's simple, but you gotta meet both.
And what's really interesting is the flexibility here. Those 2 years you live there, they don't have to be a continuous block of time. It just has to add up to 24 months total inside that 5-year window. And hey, this isn't just for traditional houses. It works for condos, co-ops, even houseboats.
Okay, theory is great, but let's see how this all works when the rubber meets the road. Let's run the numbers on a real-world example.
Check this out. So a married couple sells their place for $900 grand. We subtract their selling costs. Then we figure out their basis, what they paid plus the 80 grand in improvements. That gives them a total gain of $366,000. But wait, their exclusion is $500,000. So what's their final tax bill? Zero. They walk away paying nothing in federal taxes on that profit. But what happens if your profit is bigger than your exclusion? It's a great problem to have, right? So look at this. A single seller makes $311,000.
Impact on
They
the
just
market.
used their $250,000 exclusion to wipe out the first chunk of that profit. That means only the leftover amount, that $61,000, is what they'll actually pay taxes on.
And this is the most important part. You are not just a spectator here. You can actively take steps to shrink that taxable number before you even get to the exclusion.
Let's talk strategy. Two of the most powerful things you can do are, 1, pump up your basis. That means documenting every single capital improvement, that new roof, the kitchen remodel, you name it. And 2, timing the sale. Seriously, if you're just a few months away from hitting that 2-year mark for living in the house, just waiting could save you an absolute fortune.
All right, now we need to get into the nitty-gritty. There are some really important special rules and, let's be honest, some pitfalls that you have to know about.
The tax code actually has some really valuable provisions for when big life changes happen. For instance, a surviving spouse can still use the full $500,000 exclusion, as long as they sell within 2 years. And there are other really key rules for situations like divorce or for members of the military that can make a huge difference.
Okay, pay attention because this is a major tax trap. If you've ever claimed a home office deduction or rented out your house, any depreciation you claimed has to be recaptured. This means it gets taxed separately, and you absolutely cannot use your main home exclusion to get rid of it.
And here's another tricky one. It's called non-qualified use. Basically, if you bought a place after 2008, used it as a rental first, and then moved in later to make it your main home, a portion of your gain might not be eligible for the exclusion. Look at this example. It makes it super clear. This person owned the home for 60 months, right? But for 24 of those months, it was a rental. That's 40% of the time. So guess what? 40% of their total gain is now taxable, period. The main home exclusion can't touch that slice of the pie.
Okay, 2 more quick but crucial rules. For you investors, if you got this property through a 1031 exchange, you have to hold on to it for 5 full years to use this exclusion.
And for anyone who inherits a home, there's fantastic news. Your basis steps up to whatever the home was worth when the person passed away. This can instantly erase decades of taxable gains.
And one last thing to keep on your radar, especially for high earners. It's the 3.8% net investment income tax. If your income is above these levels, say 250 grand for a married couple, this extra tax could get tacked onto your taxable gain. All right, we have covered a ton of ground. So to make this all super practical, let's wrap it up with a simple checklist to run through before you list your home.
This is your action plan. First, confirm your timing on that 2 out of 5 year rule. Next, assemble your basis file. That means every single receipt for improvements. Then map out any special rules. Did you have a home office? Did you inherit the place? Run through this list. This is how you go from just hoping for the best to actually executing a smart tax strategy.
To get more clear, actionable strategies on complex real estate topics just like this one, make sure to subscribe.